What do underwriters do? Underwriters stand ready to buy shares in new equity issues if they're undersubscribed. Essentially, they act as a kind of insurer. As such, underwriters often hedge this risk by being short the stock. This sort of behaviour caused controversy during the Facebook IPO, with Goldman Sachs and JP Morgan, both Facebook underwriters, facilitating short selling of Facebook shares in the first days of trading. In a new piece of research from the CMCRC, which investigates trading behaviour around dividend reinvestment plans, or DRPs, we observe abnormal trading around underwritten DRPs, which is not observed in non-underwritten DRPs, highlighting the need for richer data in financial markets. While dividend reinvestment plan participation is voluntary, firms wanting to ensure they have sufficient funds can underwrite the dividend. This involves offering shares to a third party, like an investment bank. The price at which these new shares are issued is determined during the pricing period. Our research uses unique broker-level data to examine the trading conducted in all accounts of the underwriting broker during this pricing period, including both client and proprietary trades. In this chart, the selling behaviour of the underwriting broker is presented in red, while the selling behaviour of all other brokers is presented in blue. The trades of brokers in a matched DRP that is not underwritten is shown in green. The red line indicates that underwriting brokers sell around 100% more stock than during the benchmark period in each of the 10 days before the pricing period of the DRP, jumping to 400% at the start of the pricing period and remaining above 200% for the next 10 days. The blue line shows the trading of non-underwriting brokers in the same stock. Interestingly, we see no dramatic difference. This flat trading behaviour is mirrored in our matched sample of non-underwritten brokers. The striking difference between these results confirms that the increased selling during the pricing period is confined to the underwriting brokers trading and is not related to the operation of the DRP itself. To quantify the impact of this conduct, we examined the price response of underwritten DRPs during the pricing period and compared them to those of non-underwritten DRPs. On the first day of the pricing period, underwritten DRPs experienced a significant price decline, falling 5.5% on average, while the DRP stocks fall only around 2%. This reduced average price during the pricing period results in more shares being issued in an underwritten DRP and at a lower price. This has the effect of diluting existing shareholders to the benefit of those participating in the DRP, who in effect buy the shares at a discount. The implication of this research are twofold. From an investor's perspective, shareholders opting to take up the dividend should exercise caution. From a regulatory perspective, flagging trades as principal or agent, as required post-July 2014 in Australia, will enable identification of whether selling pressure during the pricing period is attributable to the proprietary trading of the underwriter or their clients.